Join us now for a look at how the rate cut could impact bank earnings and investors hungry for some yield. Marty Mosby, Director of Bank and Equity Strategy at Vining Sparks. You know, a lot of times we look at how the financial sector does, and we say, yeah, rates are low, but credit quality must be good because we're in such a good economy. God, if you've got low rates and worries about a slowdown, I don't see how you can make a positive case for banks just based on the most recent events, Marty, or can you?
Well, you have to dissect this. There's two different catalysts that create pressure, and you just touched on both of them. You've got the interest rate impact and you've got the credit side.
Right.
The interest rate impact is real, so earnings are going to be, unfortunately, impacted by about 3 to 5% more. So we already had earnings going down in this sector. We're probably going to see, instead of 3 to 5% reduction, we're probably going to see 5 to 7% reduction, just given what we had happening now as the short-term rates are moving lower. On the other side, we just saw that employment was going up. Our credit cycle monitor said that we had some cushion, so there's some strength in the economy. So there's some shock absorber on the credit side. So we're not really seeing that the credit has to materialize, and that's the bigger shoe to drop. So as long as we can keep credit in there, valuations are already starting to discount the fact that the credit cycle is going to start to kick in. And we've seen this a couple of times before when that didn't materialize.
Well, we just heard that every single economist has a forecast for a recession greater than 50%. We just heard someone posit that factually. So that if the credit cycle hasn't turned yet, apparently it's guaranteed to do so, Marty. So you've got two strikes against this sector at this point then. You've got the lower interest rates and the credit cycle.
That's exactly right. If we do see the credit cycle now begin to turn, then that's going to be an additional cost that will drive our earnings down even farther, which is why the banks react the way that they do. They are the canary in the coal mine. When we start to have this fear of recession, which we had in 2016, we had in 2018, now we're having again in 2020, the banks get hurt the most because everybody's wanting to avoid 2008. So we start to see valuations, which when we were back in December, we downgraded our stocks because we were looking at the sector and we were kind of building in all the good things and all the bad kind of fears were kind of working out. And now what we're seeing is your spring is loading on the other side. So our risk to return back in December was less than 1. We had more risk than we had return. Now, given where the valuations are, our risk to return metric is all the way up to over 2 times. So the valuation piece of this is put in between interest rates and credit. And that's what we have to see is it's a perception. It's not the reality of credit just yet.
Okay, good. So then that's you got interest rates, credit cycles, and valuation. And
that's correct.
One we know, the other one we're not sure, and the third we know, the valuation. So things are cheaper, and we don't know about the credit cycle, but we do know that this is not great for the yield curve for people that lend and what do? They lend long and whatever it is. The yield curve is bad for bank profits right now, right?
That's correct. Well, you have an offset to that hasn't really been played into yet. Deposit rates did not fall on the first 75 basis points that we went through. So now what the banks are prepared to do is to begin to recalibrate those deposit rates, which will offset some of the impact of the interest rates. So we won't see the same margin compression on this 75 basis points that we're going to get now that we had last year. So we have a little bit more of a cushion there. And then when you start, like we said, valuation-wise, we already see dividend yields starting to creep back up again. And what we'll have to watch for is this whole credit side.
Well, when will we, it all depends, doesn't it? It all depends on.
Unfortunately, it does. Yes.
Yeah. It depends on the virus and the amount of fear and whether we start doing things that some parts of the rest of the world are doing. Then the credit quality could definitely be impacted. I think. In fairness, I think we're closer now to the specter of a recession than any time. When was that, 8, 9, 10 months, a year ago, when all these economists were ramping up their probability for a recession based on nothing.
Well, based on the passage of time.
Trade war,
like we're inevitably closer than we were 8 or 9 months ago.
Right, but no, just in terms of, I understand the
But this is from real economic activity.
fragility.
This is not just,
Yeah, I understand the fragility
This is
of-
not looking
yeah.
at 10-year yields versus 2-year yields or anything else. This is based on what you are seeing globally and potentially here in the United States, and wondering when and if that is going to wash up on our shores.
Right, so to speak.
And that's the potential, right? So there is some potential economic impact that can come if this continues to kind of move in that direction. So we don't have to rush into this. This is something we can take our time. It's not like it's going to be the spring is all of a sudden going to spring and kind of bounce back that quickly. So we can watch it materialize, and then we know that if we then see the virus starting to kind of wane as we get closer into the summer, then we know the relative value built into these banks gives you that opportunity to rotate back to them. But you have time and patience on your side here. So there's no rush to have to do this.